This crisis wouldn't start the way you expect. In 1929, people didn't panic because stocks fell. They panicked because they had no idea what was real. Prices on the New York Stock Exchange were 3 or 4 or 5 hours behind, according to this account, and people flooded the streets just to find out what happened to their money. Fact, the system was slow, opaque, and largely unregulated. No SEC, insider trading was legal, no FDIC, no capital requirements for banks. Now here's the paradox. Today you can see everything instantly. Prices update in real time, your phone never sleeps, and that feels safer. But what if that speed doesn't prevent panic? What if it accelerates it? This matters to you because your savings, your job, your cost of living all sit inside that same system. Fact, the US now carries about $38 trillion in debt. Inference, the margin for error is thinner than it looks. Everyone asks, could 1929 happen again? But here's the part nobody asks out loud. What if the real risk isn't going back to 1929, but fast forwarding to something closer to 1932? It's easy to think of the 1929 crash as a freak accident, but it wasn't. It was the start of a chain reaction, a series of mistakes that led to a global disaster. The Federal Reserve did nothing, tariffs were slapped on everything, the gold standard made it impossible to inject money into the economy, and in the end, 25% unemployment became a reality. But here's the twist. The crash didn't have to cause the depression. Fact, it was the terrible policy decisions that followed the crash that led to widespread economic collapse. Inference, history isn't just about the event. It's about the decisions made afterward. Now, fast forward to today. We have the tools to prevent a disaster, right? The playbook is clear. Throw money at the problem, like we did in 2008, like we did during the pandemic. It sounds simple, but it's not. Because even with all our modern technology, we're facing a new kind of risk debt. But here's where it gets really interesting. The key question is not, will we have another crisis? It's how quickly we'll get to that point. What happens if the government decides to write a $5 trillion check to fix things and the bond market reacts by hiking up interest rates? The numbers are terrifying. A $5 trillion bailout could trigger an avalanche of consequences. Higher interest rates, austerity measures, a country struggling under the weight of its own debt. That's where the real danger lies. But let's step back. Notice what's missing here. We keep talking about economic crashes and bailouts as if they're just numbers, just a process. But we've seen how quickly the real world breaks down under pressure. Take the collapse of Silicon Valley Bank, for example. Over a weekend, panic spread like wildfire. One tweet, just one, and a rush of people tried to pull their money. Everyone acted without hesitation. In this digital age, speed isn't just a convenience, it's a risk multiplier. Fact, the technology we rely on today, our phones, our terminals, our real-time updates, may be making things worse. The information spreads faster, but that means panic spreads faster too. Inference, this level of connectivity could lead to even more irrational exuberance. Imagine how that might play out in a time of financial collapse. And now we're entering a new phase. The danger isn't just about corporate debt or stocks. It's about the rapid rise of private credit, with its lack of transparency. Private credit companies could hold trillions of dollars, and yet even the Federal Reserve doesn't fully understand how everything is connected. Let's put all this together. You have rising debt, opaque markets, and a financial system constantly on the edge. But the real issue isn't just the numbers, it's the fear that comes with them. Fear that drives markets, fear that makes people act irrationally, fear that pushes them to take risks they wouldn't normally take. That's where we see the rise of private credit. It's murky, unregulated, and growing fast. And even the most experienced financial experts are uncertain about its true scale. When you think about it, this lack of transparency is a recipe for disaster. If you don't know what's happening behind closed doors, how can you control it? That's the environment we're in right now. It's not about one company failing. It's about what happens when the system itself becomes too complicated to manage. What happens if this continues? What happens if more banks fail? If more markets collapse? If the invisible hand of the economy turns against us? We're already seeing signs of this pressure. The financial world is shifting, and it's not waiting for anyone to catch up. Now let's zoom out. What does this all mean for you? It's easy to look at financial crises from the outside, to watch the markets crash and think that's their problem, not mine. But this isn't just about Wall Street. This is about you, your job, your savings, your day-to-day life. When a crisis hits, it's the ordinary people who suffer the most. You see it in the unemployment rates, in the housing market, in the rising cost of living. When businesses fail, it's not just the executives who lose, it's everyone down the chain. And as inequality widens, the pressure only builds. But here's the kicker. The system is rigged against you. The markets move in ways you can't control. The people in power make decisions that don't always have your best interests at heart. And in this game, you're the one who feels the consequences. If this feels familiar, say so in the comments. The system is built on leverage, on incentives that make people take risks. Big ones. It's about spectacle, about selling excitement, about the promise of wealth. That's how markets are driven, how decisions are made. It's not about serving the public. It's about keeping the game going, keeping the pressure high. So what keeps this system running? Fear. Fear of missing out. Fear of being left behind. This creates a cycle where people take bigger and bigger risks, all for the chance at something more. And in the end, that pressure makes the whole system unstable. But here's the unsettling part. The very mechanisms that allow this to happen, the lack of transparency, the unrestrained risk-taking, are what keep it from being fixed. It's a system built to fail. And the people in charge, they're playing with fire, and they know it, but they're betting on the fact that no one will stop them until it's too late. So where does this leave us? The road ahead splits into two directions, both filled with uncertainty. One path leads to more instability, more debt-fueled booms and busts. The same financial crises we've seen before, but more severe and more widespread. This is where the system could crash under its own weight, dragging everyone down with it. The other path, it's equally uncertain, but it involves deep, painful reform. It's about forcing transparency in the markets, about addressing the structural inequalities that keep people on the edge. But reform requires courage, and courage is in short supply when the system benefits so many at the top. One thing is clear, change is coming, whether we're ready for it or not. And as it builds, the next move is already taking shape. The question is, how will it unfold, and who will bear the brunt of it? Here's the bottom line. We're standing at the edge of a precipice. The past is full of lessons we thought we learned, but perhaps we didn't learn them well enough. The crash of 1929 wasn't inevitable, but the decisions that followed it shaped the future in ways no one could have predicted. Today we're in a similar place. The systems are different, but the forces driving them are the same: greed, fear, and the desire for more. We can look back and wonder if we're headed for another crash, or we can look forward and realize that the choice is still ours to make. But the clock is ticking. The next crisis is already being set up, and when it hits, it may not just be another blip. It could be the moment that shifts everything. If you want to keep following this story, make sure to subscribe. The analysis doesn't stop here.